If you are trying to decide which car to purchase, you'd probably take the advice of a knowledgeable friend or a trusted automobile review source more than you would the salesman trying to sell you the car. The same is true for investing. MorningStar, a leading provider of independent investment research, helps investors all around the world reach their financial goals. By being independent, the insightful information MorningStar provides customers on stocks, mutual funds, and a myriad of other investments is free from the influence of any third party. What that means is that MorningStar is looking out for the investor, not the investment. That's what independent advice is all about, and that's why so many investors put their trust in MorningStar.
So I founded the company 25 years ago in 1984, and prior to MorningStar, I was working as a stock analyst here in Chicago. And I was a person who loved investing and could easily have spent my career as a stock analyst.
MorningStar is an unbiased source of investment information. So we serve up information to three key constituencies: individual investors, financial advisors, brokers, planners, anyone providing advice to individual investors, and last but not least, what we call institutional investors. So these would be people who run pension funds, 401k plans, and so forth.
My first full year of sales was about $100,000. Last year we did $500 million in sales. So over 25 years we just kept reinvesting our profits back into the business. And what we've tried to do is keep this laser-like focus on serving investors, but find more ways to serve them.
I think what separates us from a lot of other people in this space is that at MorningStar we've always believed that investors come first. And we started as investors. So I think of MorningStar as a product or a company that is, for investors, by investors. And at the end of the day, I think in all of financial services, if the investor doesn't win, everyone else in the process is going to lose.
The investment options available today are immense and can quickly become overwhelming to even the most seasoned investor. One of the reasons MorningStar has grown so quickly over the years is that it helps investors navigate the sea of choices and make better educated decisions. However, before individuals can benefit from the information that companies like MorningStar provide, they really need to understand the differences between all of the different types of investments.
MorningStar is an independent research firm. Our interests are completely aligned with investors. So we create our research first, and then we make our money by licensing it after we've created it. So we don't charge the issuers, the companies that we rate, for our ratings, but our ratings are completely independent.
And frankly, the individual investor today has tools at their disposal for pennies that professionals would have paid millions and millions of dollars for just a decade ago.
We have about 30 fund analysts at MorningStar. We have about 100 stock analysts. So you have the research of 130 analysts writing up individual funds, writing up individual stocks. So we're talking to the portfolio managers, we're talking to management, we're evaluating these securities, we're providing a rating of these securities to help guide investors' portfolios.
So we've really seen the flattening of the landscape, the democratization of data. And today, the challenge facing investors isn't, how do you get information on which to make a good decision? It's how do you harness all of these powerful tools to deploy them successfully.
Stocks and bonds are probably the two most well-known investments. When an investor buys a share of stock of a particular company, they are really buying a small percentage of ownership in that company. Companies sell shares in exchange for a percentage of their ownership to investors so that they can raise money to grow, expand, or launch new products. If the company does well and grows, the shares of that company's stock also grows in value.
Owning a stock makes you part owner in a company. So if the company does well, you get to share in the profits, and you may also get a dividend that's paid out as you go along.
Buying a stock is a small share of a very large business. You can buy shares in McDonald's or Whole Foods through the participation in the equity markets.
Many people have become rich by buying shares of highly successful companies like Dell, Microsoft, or Apple when they were just starting out. Stocks of companies like these have turned thousands of dollars into millions of dollars over a period of 10 to 20 years. But many people have also lost lots of money in stocks when the company that they invested in performs poorly or goes out of business.
So we have 100 stock analysts at MorningStar covering 2,000 companies. What our stock analysts do, and each one covers about 20 or 25 companies, is they're creating a discounted cash flow model. So they're looking and projecting the sales and the earnings of a company going out 15 years. Then we discount those earnings back to the present and put a value on the company. So a company is essentially the discounted value of its future earnings. So that is our so-called fair value for a company. And what we're attempting to find then is companies that trade at a discount to our appraised fair value. So the bigger the discount, the higher the rating will tend to be.
One of the key things they look at is whether the company has what they call a moat. And by that they mean, does it have a sustainable competitive advantage? And after they've looked at factors like moats and other characteristics, profitability and so forth, they then turn their attention to whether the stock is trading at a good price relative to its future prospects. So those are the key things that go into the stock star rating.
Bonds are another type of investment that helps companies or organizations raise capital. When you purchase a bond, you are in essence lending money to the company that issued that bond, with the intention that the company will pay you all of your money back, plus interest, sometime in the future. There are many different types of bonds with many different rules, features, and risk levels. But in general, bonds are considered safer investments than stocks. Because of this, they typically offer a lower return on your investment than stocks do.
Bonds are essentially IOUs from a corporation that issues debt. Companies want to raise capital, so they can issue that in the form of an IOU, a debt to investors. So with a bond, you're given a level of return. It's not going to exceed that most likely. It's in a more narrow band based on the so-called coupon or the interest rate of the bond. Though there is some fluctuation in the principal depending on interest rates, so they're typically lower return than stocks, but also lower risk. Then lowest risk of all is cash and money market funds.
You've heard the phrase, don't put all your eggs in one basket. Well, the same goes with investing. It's smart to diversify your investments or buy many different types of investments rather than just a few, so that the risk of losing money if one of these investments fails is minimized. The big question for investors is, which investments should they diversify in?
MorningStar.com has a lot of great tools for investors just starting out. So one area I would point investors to is called Investing Classroom. That's a great place to go and learn about investing generally. And then we also have what we call analyst picks. So these are our fund analysts' best ideas in a variety of categories. And I would say that if you're looking to cut through the clutter on our site and in the investment landscape overall, those fund analyst picks are a great way to get started because you can truly see our analysts' very best ideas.
Mutual funds are investments with built-in diversification. When you buy a mutual fund, you are actually buying a group of many stocks and other investments that the manager of the mutual fund has picked to match a particular investing style. For example, some mutual funds are made up of stocks of only renewable energy companies. Other mutual funds are made up of only small companies that appear to have a high potential for growth. There are other mutual funds that are made up of large, stable companies across a wide range of industries. There are thousands of mutual funds, and each one of them offers a unique risk versus reward. MorningStar built its business helping investors spot the best performing mutual funds.
A mutual fund is simply a basket of stocks or bonds or any other financial instruments. So the key advantage of a mutual fund versus owning maybe a stock or a bond individually is that you get that built-in diversification. You get a lot of different types of stocks and or bonds in a single shot.
And if you think about it, a mutual fund is a portfolio of stocks. And I think of MorningStar as being a portfolio-centric company. But what we want to do is focus on the portfolio that the investor has so that we can analyze all of the component parts. whether they're individual stocks or they're baskets of stocks like a mutual fund, to help them understand collectively what they own and anticipate perhaps what risk might be inherent with that strategy.
MorningStar.com is a great source of the latest market news and investment information, but is typically geared towards individuals who like to be in control of their own investments. Most do-it-yourself investors manage their investments through an online brokerage firm, where they can easily buy or sell stocks, bonds, or mutual funds for very low fees. Others may feel more secure in letting a financial planner or stockbroker assist them with making the right investment decisions and doing all the buying and selling for them in return for higher fees.
MorningStar.com has a lot of data, tools, and analysis and articles to help investors.
If you're a first-time investor, we've got a whole university section where you can go through, you can take courses, we've got reading lists. There's lots of on-ramps that can help you begin to make better decisions. As you begin to put money into the market, you can put your portfolio onto the site and you can track it over time. You can screen for new ideas that might supplement or enhance your portfolio.
And we try and put all of the information that's relevant for individual investors on that site. So it's broad mutual fund data, broad stock data, some of our more institutional information, say fund flow data or things that are more geared to helping institutions, we have not put on that site. So these are all of the things that an investor would use to help manage his or her portfolio.
Today, Americans are further in debt than they have ever been before. One of the reasons for this may have to do with lack of education. We don't think twice about making sure every student learns reading, writing, and arithmetic. But the subject of personal finance and investing is often completely overlooked in our educational system. Companies like MorningStar can help you in your investment decisions, but the key is to start educating yourself and to be smart about managing your money. A small percentage of people get rich in the stock market, but many more successfully grow their personal wealth to a point where they can retire carefree and financially independent. Where will your investments take you?
The financial crisis of 2007-2008 really highlights how much investors and consumers generally need good education about how to manage their finances. So a key thing to know even before you get started in investing is the risks of having too much debt. And unfortunately, that's really what we saw through the financial crisis. A lot of households not knowing the importance of keeping debt in check, borrowing only what you could afford to borrow, and ideally saving some money as well.
My favorite money manager, the first fund that I ever owned, was run by a gentleman named John Templeton. And he wrote several books, and a number of books were written about him. And in it, he preached regularly about the evils of debt. And he would talk about how he never bought a car or even a house until he had saved up all of the money to make the complete payment. Not just a down payment, but to pay for it in whole. And that's a completely different mindset than one that we've embraced as a society the last 30 years. But I think there could be some wisdom in getting back to that. The dangers of debt are huge. They can constrict your choices. They can force you to just take one path and maybe eliminate paths that would be far better for you just because you need to have the maximum amount of money today to get out of debt.
The best advice I can give somebody is to get started early. Let the laws of compounding work in your favor. So the sooner you can get started, doesn't matter how much the money is, the better off you're going to be. Not only that you'll let those dollars compound, but you'll also educate yourself. You become a better investor the earlier you start. It's not that complicated. People are often scared by investing, but just get started. The way I got started is I took one of my paychecks. I was working at a fast food restaurant, and I put it into a mutual fund. And so then I had some experience with investing. It got me interested in it. I started following it. So the sooner you can get interested, the better off you're going to be. And the value of compounding is just enormous. Just to give you some example, I invested in an IRA in the early 80s, and I put either $6,000 or $8,000 in that account. Today it's a seven-figure sum. So over about 30 years, that compounding can really grow into a very large number. But you've got to get started early. So my huge advice to anyone in college, high school, get started today. It doesn't matter how big, but just invest a few dollars, take a paycheck, put it either into a stock directly or a mutual fund, and start learning about investing.